Today, I'm going to be talking about the 3 keys to getting a mortgage pre-approval. So if you're interested in getting pre-qualified or pre-approved to purchase a home, you're going to want to stay tuned. Well, like I said, we're going to be talking about the 3 keys to a mortgage pre-approval. Inside each of these keys unlocks your ability to get pre-approved for a mortgage. It determines what mortgage program you're going to qualify for. It determines how much you're going to qualify for, as well as your interest rate and a whole host of other factors. So this is going to be an episode that you don't want to miss, and you're definitely going to want to watch this thing all the way through. So the first key number 1, is a key that a lot of people are aware of, and it is the key of your credit. When a mortgage lender is going to determine whether or not they can pre-approve you to purchase a home, a credit pull is always going to be done. I would not trust any kind of pre-approval or pre-qualification that doesn't involve getting your credit pulled, and I would even be skeptical of a soft credit pull simply because of the fact that the lender cannot run automated underwriting if they only perform a soft pull. So that can be very dangerous later on in the process. But what are we looking for? What's going on with credit and credit score? Well, we get a lot of people that say, well, I pulled my credit up on Credit Karma and it was this, or I pulled my credit up through TransUnion and it was this, or I pulled my credit up through Capital One or my credit card and it was this. And here's the reality, guys. The only way to get the credit score that a mortgage lender is going to use, as of the filming of this video, which is October of 2023, the only way that you're going to be able to get that score is either having a mortgage lender pull it or through a company called myfico.com. Those are the only 2 ways that you're going to get the scores, because the credit score that the lender pulls is the mortgage score. It's the mortgage FICO score. And that's the only 2 ways to get it. I believe it's like FICO 2, 3, and 5. I could be wrong there, but those are the scores that the lenders are going to pull. And so the only way to get them is through the lender or through myfico.com. That's why your Credit Karma score is different most of the time from what the lender is actually pulling on your behalf. And it could be higher, it could be lower, you just never know. But your credit is a key factor in determining what and if you are pre-approved for. And we're going to be looking at your score. Of course, we will also be looking at your history. But what about the score? Like, what score does it need to be? Well, that depends. I just launched a video earlier this week on the minimum credit requirements to obtain a mortgage, but it's pretty simple. Each loan program has a different credit score requirement. Each loan program is going to have a different minimum credit score requirement. And then it gets even more complicated because each lender can have their own requirement on top of whatever the minimum requirement is. And so that's why you may talk to 2 or 3 different lenders and all of their answers be different, because every company determines what their appetite for risk is. And so some companies may say whatever FHA says, that's what we'll do an FHA loan for. And others will say, we really only want to do FHA loans that have a 620 credit score or higher. And so each program and each lender will be different. With FHA, the minimum for all lenders is 500 with 10% down, 580 with 3.5% down. But that doesn't mean that you could go to a lender and they'd be willing to accept you. They may want you to have a 620 or a 640. So that's why if you've been turned down because of credit, it's really important that you talk to a different lender. So FHA is 500, 10% down, 580, 3% down. USDA is 580 technically with most lenders, but you really want to have a 640 so that you have a chance to be on the automated approval and not the manual approval. And right now rates are pretty ugly anyways, so 640 is where it's at. VA does not have a credit score requirement whatsoever. We are currently capped as a broker at 500. Many lenders, the big ones, will tell you need a 640 or a 620. That is not true. And then conventional loans, the minimum score is 620. Some lenders may cut this off at 680 or 700, maybe even 720 if they're very conservative. And you'll see the same thing with jumbo loans. Typically, you'll want like a 720 or a 680 to a 720 to qualify. So that's going to be your minimum down payment requirements for each loan programs. But remember, we are looking at the score. We're also looking at your history, and the score requirements could vary depending on the lender that you are working with. Okay, next up, key number 2 is going to be your income. How much are you earning? That is the key piece. This is probably the most important piece in a mortgage qualification because of everything. The most difficult to change is what you're currently making, right? You'd have to get a new job, or there's all these different things, right? So income is key number 2, and it is a key piece in determining what you can be pre-qualified for, it's going to determine the amount that you can borrow. And so lenders do not look at income the same way you look at income. They don't look at income the same way that a car dealer looks at income. We must look at income the way that the underwriting guidelines tell us to look at income. And what we're looking for is something called the ability to repay. Do you have the ability to repay this loan? And that is defined by, do you meet the income requirements as stated in the guidelines? And so if you're on a salary, meaning not hourly, meaning you get the same amount every 2 weeks, every week, every month, and that does not change, then that's pretty easy and straightforward. However, if you literally have any other income type, the way we look at it may not be the same as the way that you look at it. And so if you have, for instance, an hourly pay, then we're going to take your hourly rate and your average hours worked, and we're going to look at your year-to-date income, because just because you make $40 an hour doesn't mean you always get 40 hours a week. And so we actually have to average that payout to come up with how much you're actually earning. Additionally, if you're earning things like commission or bonus pay, those are actually averaged out over 2 years. And so if you just got a job commission only and you're killing it, you're 6 months in, you're making 10 grand a month or $15,000 a month, we can't use that income until it's been consistent for the last 24 months. And so if you want to buy a house and you're thinking about a job change or something that would require you to go 1099 or commission only or bonus only, then that's going to create issues for you in the realm of being able to get pre-approved. And so, if you have Social Security or disability or VA disability, right, we will actually use more because we gross that up. So your income is a key piece in determining how much you qualify for, and it's pieced together with your monthly debts. That's called debt to income ratio. I can drop a link to the video I did explaining that. Your DTI determines if you qualify and how much you qualify for, but your income is 50% of that calculation. Your debts are the other 50%. So hard to overcome overspending, but if you have little debt and good income, you're usually in good shape. If you have a lot of debt, even if you have a lot of income, it can really, really prohibit the type of home that you're able to purchase. So key number 2 is income. Key number 3 is your down payment. 3 is your down payment, your assets. What do you have available to put towards a down payment? Now, not all loans require a down payment. VA loans and USDA loans specifically do not have a down payment requirement whatsoever. And so it is possible to purchase a home using one of those programs if you negotiate properly with as little as $1,000 or less out of pocket, right? You would need to negotiate for the seller to cover all your closing costs, and then you would have a chance at being able to get one of these loan programs with very, very little out of pocket. I'm talking the expense of an appraisal and the inspection if you get a home inspection. And so your down payment does determine what loan program you qualify for. And so conventional buyers typically are going to want to have a higher down payment unless you're a low income conventional buyer, and then you might utilize one of their 3% down programs. But for most, FHA is going to make more sense if you have a low down payment versus conventional. No one is required to put 20% down. No one's required to even put 10% down. You can purchase a home with 3.5% down or 3% down with conventional or FHA, but that is a factor, right? And so what I like to tell people is you can have one or the other. You can have no down payment and good credit, or you can have bad credit and a down payment, but you can't have both. So if you're in a situation where your credit's under 640 and you don't have a down payment, you are going to find it very difficult to qualify for a mortgage. Yes, there may be some down payment assistance programs out there that offer it at a 620, but to my knowledge, most of the government-ran down payment assistance programs are going to require somewhere in the neighborhood of 640, and any of the lender ones are going to have so many points attached to the rate that you may as well have a down payment to begin with. And so your down payment is very important if you have low credit. If you don't have low credit, then there's probably options for you to go and get a zero down program like a USDA loan, like a 1% down, conventional loan through Rocket pocket or something like that. Those are going to be options for you. But the worse your credit is, the more the down payment, the more you're going to need to have some cash saved up. And it's always good to have cash saved up to purchase a home. But those are going to be the three keys that we're looking at, right? Credit, income, and down payment are going to be the three keys to getting a mortgage pre-qualification or a pre-approval. If you aren't providing documentation around those three things, if you're not giving them a credit report, if you're not providing pay stubs and W-2s and even potentially tax returns, and you're not providing bank statements, then you don't have a pre-approval. You have a hope and a wish and a prayer, and you better hope that it doesn't blow up later on in the process. And we get so many people that contact us every week because we have a presence online looking for help to rescue them from this national lender or that national lender who didn't take the time to do these three things properly for them so that they can ensure that they actually have a solid pre-approval. So those are the three keys. If you're not doing that in the pre-approval process, my advice is find a lender like us or someone else that would, and make sure that your pre-approval is solid. Hey, if you like this video, please like the video. And as always, love it if you would subscribe to the channel. I'm Channing, and I will talk to you soon.